Ladies and gentlemen, Justin Chen here. Put down whatever's in your hands and look at this. Now look at the way silver can be up, loud, green, triumphant on your screen, while the plumbing underneath keeps whispering the one word they never want you to hear: rationing. You woke up in the first days of January and the headlines are already trying to hypnotize you. They're telling you the new year is kicking off strong, that precious metals are higher, that we're just continuing last year's rally, that the market is pricing in, rate cuts, that safe haven demand is back, and that everything you're seeing is a normal, healthy breathing price discovery process. And I need you to understand something before you let that narrative settle into your bones like a sedative. The price is the decoy. The price is the theater. The price is the part of the crime scene they re-comfortable letting you stare at because it's the only part they can still repaint in real time. Because when they're in control, they love volatility. They love it the way a casino loves flashing lights, because flashing lights keep you emotional, and emotional people don't do math. Emotional people don't ask why the move happened at that exact hour. Emotional people don't ask why the move happened on a thin liquidity session when the people who could push back were asleep or on a weekend or in that dead zone where your broker's phone line might as well be a prank. Emotional people just react, and reaction is what this machine feeds on. So yes, silver is moving. Yes, it's moving with that familiar kick in the gut, that weird blend of excitement and dread, because anyone who has lived through a few cycles knows the green candle is not always good news. Sometimes the green candle is the flare shot into the sky to distract you while the real transaction happens in the shadows, in the vault, in the ledger, in the fine print. And if you've been with me for months, you already know where I'm going with this. If you're new, welcome to the part of the movie where the smiling banker stops talking and the numbers start talking. Let me ask you a simple question, the kind that should be asked on television every day but never is. If this market is healthy, why does it behave like a patient having a seizure whenever liquidity gets thin? Why do the most important moves always happen when you're least able to respond? When you can't roll, when you can't hedge, when you can't call your advisor, when you can't even get a straight quote? If it's all normal supply and demand, why does it look like a trap being sprung? And here is the part where you're going to feel that little defensive reflex in your chest. I know it because I've watched it for years. You're going to want to say, Justin, it's just markets. It's just macro. It's just expectations. No, this is not about expectations. This is about enforcement. This is about who gets punished when the paper promises stop lining up with physical reality. They want you staring at the front page story. Rate cuts, inflation, geopolitics, risk on, risk off, whatever flavor they're selling this week. But the real story is always in the back office, in the warehouse report, in the delivery mechanism, in the small, boring-looking numbers that decide whether a contract is a promise or a joke. And today, the boring numbers are screaming. I want you to picture a vault ledger the way you'd picture a hospital chart. Not the glossy brochure with smiling nurses, the real chart, the one that shows oxygen saturation, heart rate, blood pressure. Price is the brochure. The vault ledger is the chart, and the chart is telling you the same thing it has been telling you for a long time. The system survives by stretching paper claims over a finite pile of metal, and that stretch is getting tight enough that they have to manage optics daily, sometimes hourly. One of the core signals I'm watching is the warehouse stock report. Not because the total number is magic, but because the movement inside that number tells you who is being fed and who is being starved. On paper, the total pile looks huge. 449,773,368 ounces, give or take, sitting in the system. It sounds like a mountain, and they love that because mountain is comforting. Mountain makes people relax. Mountain makes people stop asking dangerous questions. So let's do the thing they hate. Let's translate the mountain into something real. And then let's talk about why the mountain is not what you think it is. Take 449 million ounces and convert it into metric tons. Divide by roughly 32,150 troy ounces per metric ton. You get something like 13,990 metric tons. That's a lot of metal, and if this were a normal market, that number would be a blanket, a cushion, a safety margin. But the blanket has holes in it, and the holes are the whole story. Because in the vault is not the same as available to you. In the vault is not the same as deliverable. In the vault is not the same as not already spoken for by someone with more power than you. And the category game they play inside that warehouse report is how they keep the illusion alive without actually adding new oxygen to the patient. There are two words you need to understand if you want to stop being a tourist in this market: eligible and registered. Eligible is metal that meets the exchange's specs and sits in the warehouse, but it is not committed for delivery. Registered is metal that is attached to a warrant, metal that is actually available to settle a futures contract through the exchange mechanism. Eligible is the food in the pantry that technically exists, but might belong to someone who has no intention of feeding you. Registered is the food set on the table, the portion that can actually be served. Now imagine a restaurant that boasts it has a warehouse full of beef. Big number, impressive, calming. But the dining room is packed, and the menu promises steak to everyone who bought a ticket, and the kitchen only has a handful of steaks actually prepped and plated. Would you feel better because the warehouse exists? Or would you start asking why they re-forcing the lights low and the music loud so you don't to notice how many people are still waiting? And now look at the daily change that everyone will ignore because it doesn't look dramatic. The warehouse total moved by about 347,557 ounces in a day. That sounds small next to the mountain, right? It sounds like nothing, but convert that nothing into something physical. 347,000 ounces is about 10.8 metric tons. That's not a rounding error. That's trucks. That's pallets. That's logistics. That's activity. Here's where the cross-examination starts. Why is there activity in the vault while the story being sold to you is all about market optimism? Why does the back office always get busy when the front office gets loud? Why does the machine move metal and paper at the same time, as if one is compensating for the other? And before you get too excited and start thinking 10 metric tons means salvation, let me punch the air out of that balloon the way reality always does. 10 metric tons of movement can mean new metal arrived. It can also mean metal was reclassified. It can also mean someone moved metal from one owner to another inside the same building. It can also mean paper changed hands and the metal was used as a prop, like a suitcase in a movie that everyone fights over, but nobody opens. The total number is not the truth. The flows, the categories, and the stress points are the truth. This is not about a price chart. This is about the credibility of settlement. This is about whether the promises embedded in derivatives still mean what you think they mean when you click buy. This is about whether the market is a market or a rationing system disguised as a market. Now, I can already hear the objections because they're trained into you. Justin, there's plenty of silver. Justin, there's always inventory. Justin, futures are hedging tools. Sure, and casinos are entertainment venues. The label isn't the point. The incentives are the point. If the system can print paper claims on silver the way it prints political promises, it will, because paper is cheap, paper is flexible, and paper is how insiders can front-run the public without ever touching a bar. Let me tell you what a paper smash really is. In plain English, it's not some mystical conspiracy chant. It's a mechanism. If I can dump a mountain of contracts in a thin moment, I can move the price without moving the metal. If I can move the price without moving the metal, I can trigger margin calls. If I can trigger margin calls, I can force leveraged players to sell at the worst moment. If I can force them to sell, I can buy what they throw away, or I can cover my own exposure at a better level, or I can protect a book that would otherwise bleed. And the best part, from their perspective, the headline reads, "Silver falls on profit taking," or "Silver dips on stronger dollar," or "Silver volatile as traders weigh Fed outlook." It reads like weather. It reads like nature. It reads like nobody is responsible. That is not a coincidence. That is not an accident. That is a confession. Because the system doesn't fear your opinion, it fears your comprehension. It fears the moment you stop reacting and start tracing incentives. It fears the moment you look at a vertical move and ask, who needed this to happen right now at this exact time for this exact reason? 2 days ago, I told you about this. I interrupted your holiday haze. That soft, dead week lull where you are half awake and half convinced the world can possibly do anything dramatic because it sighed between things to show you a signal before it went nuclear. Today, it just did. Not because the price hit a round number, but because the mechanics underneath are tightening to the point where they have to manage you, not just the market. Let's talk about the surface story they're selling this week. Rate cuts. The idea that the central bank is about to turn the dial, lower yields, weaken the currency, and therefore precious metals benefit. It's a clean story. It fits in a headline. It gives people a reason that feels respectable. It's also a partial truth wrapped around a deeper lie. Because rate cuts are not kindness. Rate cuts are not charity. Rate cuts are morphine. Rate cuts are the IV drip you give a patient when you can't cure the disease, but you need the patient conscious long enough to sign the paperwork. And the disease is not inflation. The disease is the debt structure. The disease is the fact that the system is addicted to low rates the way an addict is addicted to the next hit, because the interest expense on the pile is becoming politically and mathematically unbearable. So yes, rate cut bets can lift metals. But that's not the real story. This is not about Fed bets. This is about a balance sheet reality that can't escape. This is about a machine that has promised more stability than it can deliver. And every time the promise gets tested, the response is not transparency. It's more theater. You can see the theater in how they talk about safe haven demand. Geopolitical tensions, uncertainty, risk aversion. They talk like the world is a storm and they're just reporting the weather. Meanwhile, behind the scenes, the financial plumbing is built like an emergency room, not a cathedral, and the people who run it have been doing triage for so long they confuse triage with healing. Here's what they won't say out loud. When the world gets unstable, physical flows matter more. When physical flows matter more, the premium between places matters more. When the premium between places matters more, arbitrage becomes a weapon, not a boring academic concept. Arbitrage is just a fancy word for if it's cheaper here than there, someone is going to try to move it. And if moving it becomes difficult, the premium grows, and the premium is the market screaming that the paper price is lying. This is where the East versus West storyline comes back, the one people love to mock until they're forced to live it. There are markets where silver is treated as a strategic input, a component in an industrial machine that doesn't care about your emotions. And there are markets where silver is treated like a casino chip, a leveraged side bet, a liquid instrument that can be printed and smashed and rehypothecated until the underlying metal becomes a rumor. When those two cultures collide, you get tension, you get gaps, you get premiums, you get a world where the same metal has two different prices, and that is the definition of a bifurcated market. Now, the mainstream will tell you that any gap is temporary. They will call it logistics, they will call it FX, they will call it taxes, and sometimes those things are part of the story, yes, but the part they won't say is that a persistent gap is a warning flare. It is the market telling you that paper and physical are no longer the same product. And this is where your brain needs to become cruel, the way a good investigator becomes cruel. You don't accept comforting explanations when the crime scene is still warm. You don't accept temporary when the pattern has been repeating for years. You don't accept liquidity as a neutral word when liquidity is the very thing they weaponize against you. Let me say it clearly. Liquidity is not a blessing in the system. Liquidity is a tool. Liquidity is how they can move size without moving substance. Liquidity is how they can punish you for being late, for being emotional, for being leveraged. Liquidity is the water they pour over the floor so you slip while they walk across in shoes designed not to slide. And the moment liquidity thins, the moment the floor dries, you see the architecture, you see the support beams, you see where the stress is, you see what can break. That's why the most violent moves happen in thin liquidity. That's why the accidents cluster around holidays and weekends and dead sessions. Because that's when the people who can challenge the move are not in the room. And that's when the move can be explained away as market conditions. Now let's do another piece of math. Because numbers are weapons and they hate when you pick them up. If the vault system holds roughly 449 million ounces, and silver is trading around $72 per ounce, what is the notional value of that pile at current prices? Multiply it. Roughly $32,730 million. That's not pocket change. That's not a hobby. That is a strategic pool of collateral in a world where collateral is becoming more valuable than money itself. And the daily change we talked about, that 347,000 ounces at $72 per ounce, that's roughly $25 million of metal moving on the ledger. Again, not trivial. Again, not just a report. It's activity. It's oxygen being shuffled. It's the hospital staff running. So ask yourself, if everything is calm, why are they running? If everything is fine, why is the back office busy? If this is just a normal market, why does the system look like it's constantly managing a shortage of deliverable credibility? Because that's what this is. A credibility shortage, a trust shortage, a settlement shortage. And the reason it matters is because trust is the foundation of every paper claim you own, whether you want to admit it or not. You think you own things in the system. You think you own shares, you own contracts, you own exposure. But what you actually own is a promise, a line in a database, a claim on a claim on a claim. And most of the time, that's fine, because most of the time, nobody demands the underlying thing. Most of the time, the game is musical chairs, but nobody stops the music. The nightmare begins when someone stops the music. The nightmare begins when someone says, I want delivery. The nightmare begins when the system realizes the chairs are fewer than the bodies. And the only way to avoid a public stampede is to keep everyone dancing, keep everyone distracted, keep everyone emotional. That's why paper games intensify, right when physical demand intensifies. Because if physical demand starts pulling on the metal, paper has to compensate by shaking the weak hands out of the tree, not because they hate you personally, but because the system is designed to protect itself, and you are the easiest pressure release valve. Let me tell you how the trap works at the human level, because people are the fuel. First, they let the narrative build. They let the bullish story creep in. They let the talking heads start saying, this is a new era for metals. They let retail get comfortable. They let people add leverage. They let people chase. They let you believe you're finally right. Then they smash it. They smash it when the book is crowded. They smash it when the stop losses are obvious. They smash it when margin requirements can do the dirty work for them. They smash it not to prove you wrong, but to harvest your forced liquidation. Because forced liquidation is not a market event. Forced liquidation is a transfer. And after the smash, they offer you the explanation. They hand you the sedative. Stronger dollar, profit taking. Risk on, technical resistance. They talk about it like it's nature. They talk about it like a thunderstorm. But storms don't hit the same vulnerable neighborhood every time. Storms don't mysteriously avoid the penthouses. Storms don't always arrive exactly when the insurance policy is about to expire. This is not about price volatility. This is about control of positioning. It's about who gets to survive leverage. It's about who gets to dictate the terms of settlement when the system is under stress. Now, I want you to consider what happens when the surface story says silver is up, while the plumbing story says inventory is shifting. Two stories at once. That's not an accident. That's the signature of a market being managed. They need the price to do one thing for optics, while they need the vault to do another thing for survival. Think of it like a theater set. The audience sees the painted backdrop. The crew behind the curtain moves the supports and the ropes so the set doesn't collapse. Price is the backdrop. Inventory movement is the crew. The crew doesn't move unless something is wrong or something is about to happen. And this is where I need to be brutally honest with you. I don't know exactly which actor will break first. I don't know exactly which bank will blink first. I don't know exactly which fund will get a margin call at the worst possible moment and become the sacrificial offering. But I do know the design. The design is built to protect insiders and sacrifice outsiders. If you want to see it, look at the language of regulators and exchanges whenever stress increases. It's always the same. Orderly markets, stability, temporary measures, enhanced risk management. Those phrases are the verbal equivalent of smoke in a hallway. They are not written for you. They are written to buy time. Because when they say orderly, what they mean is controlled. When they say stability, what they mean is nobody panic in public. When they say risk management, what they mean is we are raising the cost of participation for smaller players so the big ones can reposition. And you can't blame them in a way because that's what a cartel does. A cartel protects itself. A cartel coordinates. A cartel uses rule changes the way a street crew uses alleyways. The only difference is the cartel wears suits and calls itself market infrastructure. Now, let's take a breath and go deeper into how the paper to physical mismatch actually builds pressure. Because I don't want you to walk away with slogans. I want you to walk away with comprehension. Futures markets were created to hedge price risk. That's the official fairy tale. But in practice, futures markets become a leverage engine. They allow enormous exposure to be created with a fraction of the underlying value as margin. That's not inherently evil, it's just potent. And in a world run by incentives, potent tools get weaponized. If you can control the marginal price with paper flow, you can influence perception. If you can influence perception, you can influence behavior. If you can influence behavior, you can influence flows. And flows are what matter because flows determine who gets metal and who gets paper. When a big participant wants to cap price, they don't need to own all the metal. They need to own the moment. They need to own the bid stack. They need to dump enough paper to overwhelm buyers for a brief window, trigger stops, push price into a pocket where panic ignites. That's all. Because panic cascades. Panic is a chemical reaction in markets. It spreads through leverage. It spreads through risk limits. It spreads through algorithms that don't have souls but do have triggers. It spreads through traders who have bosses, who have committees, who have quarterly targets. And once the cascade starts, the initiator can step aside and let the machine do the rest. That's why I keep saying the most violent moves are confessions. They're confessions of a system that cannot allow a free price at the wrong time. They risk confessions of a system that needs to keep the paper credibility intact, because if it breaks, the question becomes unavoidable. What is this contract actually worth if delivery becomes inconvenient? Now, you might be thinking, but silver's price is high. Doesn't that mean the system is losing control? Sometimes, but control is not binary. Control is a dial. And sometimes the system allows price to rise because the alternative is worse. Here's a darker truth. A controlled rise can be part of the plan. A controlled rise can be used to lure in late buyers. A controlled rise can be used to build a crowded trade. A controlled rise can be used to create a bigger pool of leverage to harvest later. A controlled rise can also be used to justify rule changes, margin increases, and narrative pivots. We had to act, they'll say, as if they're firefighters, not arsonists. So when you see silver up 2%, don't celebrate like it's a victory parade. Not yet. First ask, who benefits from that move? Does it relieve pressure on someone's book? Does it stress someone else's book? Does it attract new money that can be later harvested? Does it change the cost of carry? Does it shift the incentives around delivery? Because delivery is the hammer that breaks illusions. You can trade paper forever until someone demands the thing. That's when the difference between exposure and ownership becomes a knife. And let me be clear about something, because I'm not here to sell you hero fantasies. I'm not telling you the vault is empty. I'm telling you the vault is a chessboard. I'm telling you the metal in the vault is not all available to you. And pretending it is like pretending the cash in a bank belongs to whoever walks in next. You can pretend that as long as nobody tests it. The moment it's tested, the rules reveal themselves. This is not about scarcity as a slogan. This is about constraints as a mechanism. It's about the fact that when constraints bind, power shows up. Power decides who gets served first. Power decides who gets cash settlement. Power decides who gets delayed. Power decides who gets a phone call and who gets a form email. Now, I want to talk about the psychological trap, because the psychological trap is half the operation. They train you to associate volatility with risk and calm with safety. But in rigged markets, calm is often the most dangerous phase. Calm is when the lie is being built. Calm is when leverage is creeping in quietly. Calm is when the narrative is being planted, so that when the move happens, you already have a story to explain it that absolves the system. Volatility, by contrast, is often when the lie is stressed enough to show cracks. Volatility is when the mask slips. Volatility is when people start asking questions. That's why the system tries to redirect your attention during volatility. It tries to turn volatility into entertainment. It tries to turn volatility into sports. Up, down, who cares? Just keep watching the ticker. But if you're watching the ticker like it's a scoreboard, you're not watching the game that matters. The game that matters is collateral. The game that matters is settlement. The game that matters is who can meet a margin call when the price moves against them, and who gets a bailout when they can't. Let's talk about margin calls in the real world for a second, because people speak about them like they're just risk management. A margin call is the system saying, pay up now or we liquidate you. It's immediate. It's brutal. It doesn't care about your thesis. It doesn't care about your long-term view. It doesn't care about fairness. It cares about survival of the clearing system. And here's the betrayal. The clearing system is designed to be strict with you and flexible with them. You get liquidated, they get facilities, you get forced selling, they get meetings, you get a phone call from your broker, they get a call from the central bank. That's not a conspiracy theory. That's the design of a captured system. Repo is the emergency room for banks. You only show up there when you're bleeding out. And even without quoting facility numbers tonight, you can feel the pattern in the air. When stress rises, facilities expand. When stress rises, temporary measures become permanent. When stress rises, the public is told everything is fine while the private sector is handed oxygen. And that's why precious metals matter. Not because they're magical, not because they're a religion, but because they are one of the few assets that sit outside the promise stack. They don't require a counterparty to exist. They don't require a central bank's narrative to be believed. They don't require a regulator's blessing to have value. And that is why the system has spent decades treating metals like a nuisance. A nuisance is not something you ignore. A nuisance is something you manage, something you suppress, something you keep contained. Because metals are a vote against the system's credibility. Metals are a memory of money before the promises became the product. Now, let ES return to the vault number and talk about why a big total number can still mask fragility. Imagine two scenarios. In the first scenario, the vault is full of metal that is unencumbered, willing to be delivered, ready to settle contracts. In the second scenario, the vault is full of metal that is owned by parties who do not need cash and do not want to sell. Metal that is pledged metal, that is collateral metal, that is sitting there like a statue while the paper market dances around it. Both scenarios look identical if you only stare at the total number, but the stress behavior differs. In the first scenario, delivery pressure is easy. In the second scenario, delivery pressure is a nightmare, because the metal is there, but it's not for you. It's like looking at a warehouse full of food during a famine, and being told, don't worry, there's plenty, while the doors remain locked. That's why registered versus eligible matters. That's why daily category shifts matter. That's why the boring report matters, because it tells you whether the doors are opening or staying locked. Now, I know some people will hear this and immediately jump to conclusions. So what happens next? Do we moon? Do we crash? Do we squeeze? If you're asking those questions, you're still thinking like a gambler. And I don't say that to insult you. I say it because the system wants you thinking like a gambler. A gambler asks, what's the next move? An investigator asks, what is the mechanism and who is trapped? Who is trapped when physical demand increases but paper claims are massive? Anyone short who assumed they could always roll. Anyone leveraged who assumed liquidity would always be there. Anyone who promised delivery without controlling supply. Anyone who built a model that treats history like physics instead of like politics. And who is protected? The institutions with access to emergency oxygen. The institutions with influence over rules. The institutions with the ability to move size in the shadows while the public trades in the spotlight. This is not about silver as a metal. This is about silver as a stress test. It's a test of whether the financial system can still pretend that paper is reality. It is a test of whether the cartel can still control the narrative long enough to extract value from the public before the public realizes the game. And here's where the dark humor comes in, because if you don't laugh, you'll grind your teeth into dust. They will tell you the market is efficient. They will tell you it's transparent. They will tell you it's regulated. Meanwhile, the most important outcomes are decided by a handful of categories on a warehouse report and a handful of timing decisions on a trading desk. That's the efficiency, that's the transparency, that's the regulation. The truth is simpler. The market is a stage. The real market is the plumbing. And the plumbing is always where the lies go to die. So let me walk you through a scenario, not as prophecy, but as mechanism. Suppose physical demand keeps pulling. Suppose industrial buyers who don't care about headlines keep needing metal. Suppose geopolitical uncertainty keeps people wanting real collateral. Suppose rate cut expectations keep pressure on the currency narrative. All of that feeds a background hunger. Now suppose, at the same time, the paper market remains crowded with leveraged positions. There are longs who think they're geniuses. There are shorts who think they're untouchable. There are funds who think they can arbitrage everything. There are banks who think they can manage flows forever. In that environment, the system's job becomes not price discovery, but damage control. Damage control looks like this. They allow price to rise enough to create excitement, then they smash it to flush leverage. They let it rise again, then they smash it again. They use volatility like a washing machine. Every cycle squeezes out some weak hands. Every cycle harvests some margin. Every cycle transfers some position from emotional players to strategic players. And while that's happening, the vault ledger is being managed. Metal is being moved, reclassified, pledged, unpledged, warranted, unwarranted. The numbers tick, not always dramatically, but consistently, like a heartbeat under stress. And the public, trained to stare at candles, misses the heartbeat. That's why I keep hammering on the same principle. They can print paper. They cannot print metal. They can create claims. They cannot create atoms. They can create narratives. They cannot create supply chains overnight. And the most dangerous phase is when the system is forced to pretend paper and physical are the same while the world is screaming they are not. That's when rule changes arrive. That's when delivery incentives change. That's when cash settlement options become more attractive. That's when the language shifts. Watch language. Language is the first leak in any controlled system. When they start emphasizing orderly markets, when they start emphasizing liquidity provision, when they start emphasizing temporary measures, that's the system telling you it's scared. And when a system like this is scared, it does not become honest. It becomes more manipulative. Now, let me hit you with another reversal, because you need it. This is not about making money on a trade. This is about surviving the transition from a trust-based system to a constraint-based system. People are still living as if trust is infinite. Trust is not infinite. Trust is a resource. And this machine has been burning that resource for decades. Inflation is one betrayal. It's the betrayal of savers, the slow theft that lets politicians buy votes, and bankers buy yachts while you pay more for groceries and get told it's normal. But inflation is only the surface betrayal. The deeper betrayal is the betrayal of settlement, the betrayal of the idea that a promise equals the thing promised. When you buy a paper claim, you're trusting that the chain of promises behind it holds. You're trusting that the system will honor the contract even under stress. You are trusting that the rules will not be changed mid-game. And if you've lived through enough cycles, you know that trust is optimistic. They change rules when they need to. They redefine words when they need to. They invent new facilities when they need to. They call it innovation. They call it stability. I call it improvisation because the script only works as long as you believe it. Now, apply that template to metals. First, the vault is plentiful. Then it's adequate. Then it's tight but manageable. Then it's logistical. Then it's temporary measures. Then it's orderly settlement. Do you see the pattern? The words shift as pressure increases. And the reason I'm here, again, sounding like the guy at the edge of the party waving a fire extinguisher while everyone laughs, is because I've seen what happens when the words get too soft. That's when the patient is in real trouble. When the nurse starts smiling too hard, it's because the chart is ugly. So where are we right now? We're at the point where price is rising, narratives are bullish, and the vault ledger is active. That combination is not comfort, it's tension. It is the system trying to ride the line between letting price reflect some reality while not letting price reflect all reality, because all reality would be too embarrassing. And here's the thing you need to internalize, because it will keep you sane. They can manage price in the short run. They can manage headlines daily. They can manage optics minute to minute. They cannot manage physics forever. They can't manage the fact that mines take years. They can't manage the fact that industrial demand doesn't care about their talking points. They can't manage the fact that geopolitical fragmentation changes trade flows. They can't manage the fact that debt math is compounding. They can't manage the fact that trust, once broken, does not fully return. That's why the long game is not about guessing tomorrow's candle. The long game is about seeing the structural shifts. It's about understanding why the system's behavior is becoming more aggressive, more theatrical, more volatile, more manipulative. It's because the constraints are tightening, and when constraints tighten, cartels get mean. Let's talk about why cartels get mean in a way you can feel. Imagine you're running a scam. As long as the scam is working, you can be polite, you can be charming, you can be generous, you can throw a little profit at people to keep them happy. But when the scam starts failing, when people start asking questions, when withdrawals increase, when the numbers stop adding up, that's when you get aggressive. That's when you threaten. That's when you gaslight. That's when you smash the fire alarm. Because kindness is easy when you're winning. Control is hard when you're losing. The financial system is in the phase where control is getting harder. And you can see it in how often the market convulses. You can see it in how quickly narratives change. You can see it in how desperate the experts sound when they repeat the same lines like prayers. Soft landing, contained, orderly, temporary. It's a priesthood reading from a book while the roof leaks. So let me give you a mental model you can carry. Think of silver as a pressure gauge. When the gauge rises, it's not just telling you about silver. It's telling you about the system's stress. It's telling you about the trust environment. It's telling you about collateral hunger. It's telling you about the health of the promise stack. And when the gauge rises, the system has choices. It can let the gauge rise freely and accept the message, or it can try to manipulate the gauge to hide the message. The second choice creates volatility, and volatility creates casualties, and casualties are often you. This is why I keep warning you about leverage. Not because I'm moralizing, not because I'm anti-fun, but because leverage is the system's favorite way to turn your correct thesis into your personal disaster. You can be right about the long-term direction and still get destroyed by the short-term convulsion if you repositioned in a way that cannot survive a smash. I'm not telling you what to buy or sell. I'm telling you how the battlefield is designed. I'm telling you the system's favorite weapon is not a gun. It's a margin call. It's a timing move. It's a liquidity ambush. It's a narrative pivot that causes emotional people to stampede in the wrong direction. Now, let's go back to the vault ledger one more time, because I want you to understand why even a large total doesn't end the debate. $32 billion of metal sitting in a system sounds like a fortress. But a fortress can fall if the gates are controlled by people with different incentives than you. If that metal is mostly held by parties who do not need to sell, it will not flow when you need it. If that metal is held as collateral in other deals, it will not be released without consequences. If that metal is held by industrial actors who treat it as supply security, it will not be dumped because a talking head says profit-taking. So the real question is not how much exists. The real question is how much is available at the margin, at the moment of stress, at the price that matters, under the rules that will exist when panic arrives. That is always the question, and it was always the question the mainstream avoids because it forces them to admit the market is not a clean machine. It's a political machine. And when you admit it's political, you have to admit the winners and losers are chosen. You have to admit the rules are discretionary. You have to admit the referee is not neutral. And once people believe that, the whole theater collapses. So what do we watch from here? Not the candle. We watch the signals that reveal constraint. We watch vault categories. We watch persistent premiums. We watch settlement language. We watch whether the system begins to encourage cash settlement more aggressively. We watch whether the media begins to mock metals harder, because mockery is often a sign they want you away from something. They mock what threatens them. They ignore what doesn't. That is why you can get 20 hours of coverage on some celebrity divorce and 5 seconds on a structural market stress signal. The media is part of the machine. It's the lullaby. It's the soft voice that keeps you asleep while the back office moves. And yes, I'm angry about it. I'm angry because I've watched ordinary people get fed the same lies for decades. Work harder, save more, trust the experts. Buy the index, don't question the system. Meanwhile, the system changes the rules whenever it needs to protect itself. That is betrayal, repeated, normalized, disguised as adulthood. So here's the climax, the part I want burned into your memory because it will frame everything you see next. When the price of silver moves violently, it is not just a market event. It is a negotiation between paper and physical. It is a negotiation between insiders and outsiders. It is a negotiation between the narrative and the math. And the math is always the final judge. The math doesn't care about your politics. The math doesn't care about your feelings. The math doesn't care about the central bank's confidence. The math cares about constraints, about flows, about settlement capacity. If the system has built a tower of paper claims on a foundation of physical that cannot support the tower under stress, the tower will not politely wobble. It will snap. And when it snaps, the system will not apologize. It will improvise. It will offer cash. It will offer new rules. It will offer new narratives. It will offer anything except the one thing that would expose the lie. A free, unconstrained price that reflects actual scarcity of deliverable credibility. That's why I'm not here celebrating a green candle. I'm here watching the lie flinch. Because it's happening more often now. It's happening in the way price behaves. It's happening in the way the vault ledger stays active. It's happening in the way narratives have to be rewritten faster and faster. And once a lie this big flinches in public, it never fully recovers. It can keep performing. It can keep buying time. It can keep managing optics. But the audience changes. The audience starts watching the hands, not the smile. The audience starts listening to the math, not the talking head. So what do you do with this, mentally? You stop letting them control your emotional state with their fireworks. You stop letting the candle be your religion. You stop letting daily noise erase structural truth. You treat the market like a crime scene, because it is. You treat every violent move like a question, because it is. You ask who benefits, who is trapped, who is protected, who is being sacrificed. And you remember the fundamental betrayal. The betrayal is not that prices move. Prices should move. The betrayal is that the system pretends the move is organic, while it quietly uses paper and rules to steer outcomes, then blames you for being surprised. The betrayal is that they call it vitriol at free markets, while managing settlement credibility like a rationing committee. This is not about a couple percent up or down. This is about the moment ordinary people realize they're not participants in a fair market. They're fuel. They're exit liquidity. They're the emotional mass that makes the transfer possible. And if you feel tired hearing that, good. That fatigue is your soul resisting manipulation. That fatigue is your mind realizing it's been trained to accept betrayal as normal. That fatigue is the first step toward clarity. Because clarity is rebellion in a system built on confusion. Clarity is how you stop being harvested. Clarity is how you stop being the guy who shows up at the end of the movie asking why everyone is running. So tonight, when you see the charts convulse, when you see silver pop and dip and pop again, when you see the headlines try to package it into a tidy little story, remember what I told you. Remember the vault ledger. Remember the category game. Remember that 449 million ounces is not the same as deliverable credibility. Remember that 10 metric tons moving in a day is not nothing. It's activity, it's stress, it's management. Remember that $32 billion of collateral sitting in warehouses is not a guarantee of fairness. It's a guarantee that powerful people care deeply about controlling perception. And when powerful people care deeply about controlling perception, it's because reality is dangerous to them. I'm not asking you to be afraid. Fear is what they sell. I'm asking you to be awake. Awake people don't get harvested as easily. Awake people don't panic on cue. Awake people don't chase fireworks. Awake people do the math, and then they watch the incentives, and then they stop believing priests in suits who have lied for a half century. My name is Justin Chen. If you want to walk through this fire with me, hit subscribe, share this with someone who's still asleep, and I'll see you on the other side.